So today's lecture is on Chapter 17, and it's going to be probably the shortest of all of your lectures this term because it's all about formulas and financial analysis. So you're really going to have to do the work in reviewing all of the formulas that you'll need to know and working out the practice. So the way that I've set up this video is essentially I've got a companion financial statement that you'll find in Canvas called Chapter 17 Financial Statement, and you're going to use it to find all the numbers that I use in this video. So essentially this is a video and a practice all at the same time, because the answers are all in this video. It's just going to give you the ability to practice on a set of financial statements, all of your formulas, and then you can check them in this video. And the main point I want to show you here is the uses of these financial statements. Now you can find all of the formulas in Chapter 17 listed on page 816. And not only are they listed on page 816, but they're also organized by type of formula, and we'll talk about types in a second, and then the use of the formula. So it's not only important to be able to figure out how to find the numbers on a financial statement to put into the formula, but you also need to know what it's used for. And then when you get your answer for the formula, is it a good result for the company, or is the company doing poorly? So we're going to talk about that mostly in this video, and then you'll need to go back and try all the formulas for the financial statements I've provided and then check your answers. So the first analysis that I want to talk about is horizontal and vertical analysis. So you can see examples of a horizontal analysis in Exhibit 3 and 4 in your book, and a vertical analysis in Exhibit 5 and 6 in your book. And so you'll really need to look at these while I'm talking so that you can see what I'm talking about. Really, in a horizontal analysis, you're comparing prior year numbers to current year. So the way that you get the percentage of change indicated on your horizontal analysis is you're going to take the current year number minus prior year and divide it by the base year. So your base year is going to be your prior year. And then you'll get a percentage, and that's your percentage of change from last year to this year. Horizontal analysis is a little bit different in that we're looking at the same period, not two different periods. So your percentage is a reflection of a line item divided by a main total. So if you look at Exhibit 5 and 6, you'll see that there's a main total indicated by 100% next to it, and all the line items, those amounts are divided by that main total to get those percentages. So take a look at the vertical and horizontal analysis in your book. And also, before we get started on the financial statements, check out Exhibit 7. It is common-sized statements. So common-sized statements are really great to use when you're analyzing financials for two different companies and the companies are different sizes. So this is a way that you can break down the percentages so that you can compare the two and not worry about one is bigger than the other. Common size statements are specifically a vertical analysis for two companies, taken all the way down just to the percentages and then comparing them side by side. So take a look at Exhibit 7 as well. So the first set of formulas that we're going to go through are liquidity and solvency. So liquidity and solvency are what we're trying to measure for a company. So liquidity will be the ability for that company to convert its assets into cash, and solvency is the ability for a company to pay its debt. So the first formula is called working capital. It's going to be very similar to the second formula because they're using the same numbers. And we're really trying to measure this company's ability to meet its current obligations. And if you get a positive result for working capital, then that's a good thing. And for current ratio, if you get a number greater than 1 in your answer, that's a good thing. So working capital is current assets minus current liabilities, and current ratio is current assets divided by current liabilities. And the numbers that you see here, again, are from the financial statements that I've posted. So you can calculate this on your own and then come back and check your answer to see what I came up with. Okay, the quick ratio is like the current ratio, except we take out assets that aren't really easily converted to cash. So we're only going to use quick assets instead of current assets. So the quick assets here, I would include cash, short-term investments, and accounts receivable. Notice it doesn't include inventory or prepaid expenses or anything that's going to take some time to convert. So then we take quick assets divided by our current liabilities to get the answer. So if you look at this answer here is 2.4, which is greater than 1, and that's where we want it to be. We want this number to result in greater than 1. So that's the third formula. And all of these first three are measuring solvency. Okay? Accounts receivable analysis. Now, when we're assessing accounts receivable, we're really trying to assess our efficiency in collecting receivables and in managements and how we manage our credit. So this first one is called number of days sales in receivables. And you're going to take the average accounts receivable divided by the average daily sales. So you're actually going to have to make several calculations just to get this answer. The first thing you do is calculate average accounts receivable. To do that, you're going to take the current year accounts receivable, which in the financial statements I've given you is the year 2012, and then the prior year balance in accounts receivable, which is the year 2011, and divide that by 2. That's going to be your numerator of this formula. Then, to get the average daily sales, we're going to have to find our sales number, only our credit sales. So we're not worried about cash sales here because cash we already received. Those aren't going to be receivable. So we're only worried about those that are receivable. So credit sales divided by 365 days. So in your example financial statements, you can see that our sales are $9 million, and I believe we're just assuming they're all credit sales. Dividing that by 365. You want this number to be lower than the credit terms. So here, if our answer is 23 days, and we've given customers 30 days to pay us, then that's pretty good. We're happy about that answer. But if that number were higher, like 40 or 50 days, and we're only giving customers 30 days to pay us, then we've got a problem. Customers are taking too long to pay us. So start with average AR, then calculate your average daily sales and plug them into this formula to get your number of days is your answer. Okay, inventory analysis is where we're trying to assess our efficiency in measuring our inventory. So this is a liquidity measure. This first one is inventory turnover. And I abbreviated the numerator here. It's cost of goods sold divided by average inventory. So you ought to be able to find cost of goods sold over on the income statement. And average inventory, you're going to have to go to the balance sheet. The second thing, so you can, first thing is cost of goods sold. The second thing you'll do is take the prior year inventory plus the current year inventory and divide it by 2 to get your denominator. You want this answer to be greater than 1, and I've done an example here from the financial statements. in Canvas. Here's another liquidity measure for inventory, which is number of days sales in inventory. So this one's kind of like accounts receivable, where you're going to have to make a couple of calculations to get the answer. First, you're going to start off with average inventory, where you're going to take current year plus prior divided by 2 to get your average inventory. Then you're going to take cost of goods sold and divide that by 365 to get your average daily cost of goods sold. Here we rounded up the answer to 78 days. So we really want to see this number over time. We want to see this number decreasing. And this is measuring the length of time it takes to purchase, then sell, and then repurchase inventory. So it's our inventory cycle. So we want to be getting more efficient at this process or this cycle. And so we'd like to see this number decreasing. So as we look at this number over time, we would like to see 78 become 75, 72, 68. We'd want to see that number going down. All right, next up is a ratio of fixed assets to long-term assets. And this number is really to indicate the margin of safety for long-term creditors. So we're measuring solvency. And we want to know, if we had to sell off all our fixed assets, would we be able to pay our liabilities? We want this number to be greater than 1. So we're going to take net fixed assets, which is the cost of your equipment, land, all of any items that are long-term assets like a building, furniture, anything like that. You're going to add it up and then take out any depreciation that we've already taken out. So minus all the accumulated depreciation, that's your numerator. In your financial statements, I believe you are given net fixed assets, but you'll want to make sure to take out depreciation. Divided by only the long-term liabilities. So you don't want to include any current liabilities here, just long-term. The ratio of liability to stockholders' equity is we're trying to find out also the margin of safety for our creditors. This is a measure of solvency, and we're trying to see that if we had to wind up this company, would we be able to pay our creditors? So we want this number to be less than 1. And in trends, we'd like to see it decreasing. So you're going to take your total liabilities, that includes current and long-term, and divide it by your total stockholders' equity to get your answer. Okay, so number of times interest earned is to assess the risk to debt holders in terms of number of times interest charges were earned. This is a measure of solvency. So we're trying to figure out how many times, because of the debt that we have we earned our interest. And we want this number to be greater than 1 and increasing when we're looking at trends. So you want to take this is a total, not a balance, a total off of your financial statements called income before taxes, and add back interest expense, and then divide it by interest expense to get your answer. So that wraps up all of our solvency and liquidity formulas. Now we're going to move on to profitability. Profitability, start off with ratio sales to assets. And this is where really assessing our effectiveness to use our assets to make money. So we're going to divide our sales by our average total assets. But when we take the average of our total assets, we're going to exclude any long-term investments. We don't want the money that we make on our long-term investments to be included in this analysis. So the first thing that you need to do is put your sales in the numerator. The second thing is to add up your total assets that don't include long-term investments. Divide that by 2 to get your average. And your answer will be a percentage. Okay, and we like this to be increasing in a trend. Okay, next up is the rate earned on total assets. We're trying to assess, again, our profitability of our assets. We're going to take net income, which is not a balance, it's a total on your financial statements, and add back interest expense, and then divide it by the average total assets. Now here, you can include those long-term investments, so include the actual total assets, take the average by dividing last year and this year by 2, and that's your denominator. The answer is going to be a percentage, and you like to see this increasing as we analyze this over time. Okay, and here's the work here. All right, next up, rate earned on stockholders' equity. We would like this to be assessing our profitability of our investments from our stockholders. So this answer is going to be a percentage. We're going to take net income divided by average stockholders' equity. So you can take last year's total stockholders' equity, this year's total, divide by 2 to get your denominator. And then you can run the numbers. I've done an example for you here from the financial statements. Rate earned on common stockholders' equity. So this one's very similar to the previous, except we're only talking about common stockholders' equity. So what we want to do is remove preferred dividends from the numerator. So you take net income minus preferred dividends. You can find preferred dividends over on the first page of the financial statements under the statement of stockholders' equity. And you're going to divide that by only common stockholders' equity. So this includes retained earnings and includes common stock, but does not include preferred stock. So take those totals for each of the 2 years, add them together, and divide by 2 to get your denominator. So there's an example that I've done here for you where you've got common stock from prior year, current year, you add them together, divide by 2. Earnings per share. Our numerator is going to be the same. So we're going to take net income divided by preferred dividends. This one should look really familiar because we did it a few chapters ago. And you're going to divide it by the number of common shares outstanding. So the denominator is not a balance, it's a number of shares outstanding. And that's going to be a dollar amount is going to be your answer. Price earnings ratio tells you how expensive this investment is. So if you run this analysis on Amazon, you can see that they have a really high PE ratio because Amazon stock is really expensive, over $2,000. So we're going to take the market price per share. In the financial statements I've given you, this is at the very top. It tells you what the market price is. And divide it by our previous answer, earnings per share. So you're going to want to take whatever answer you got up here and make it your denominator. So you actually have to run 2 calculations here. You got to run earnings per share first, and then you'll get your answer. This is not necessarily in dollars. This is, you're going to round it to the first decimal place. Okay, dividends per share is the next one. You're going to take dividends on common shares, which is in the statement of stockholders' equity on the first page, and divide it by the number of common shares outstanding. This number is in dollars. And then dividend yield, you're going to take your answer from above. So your dividends per share is your numerator, and you're going to divide it by that market price. Your answer is going to be a percentage. And then the last formula is number of times preferred dividends is earned. Oh, it looks like I forgot this one. This one is actually a liquidity, or it's not. Let's see. No, this is actually a solvency formula that I forgot to mention earlier, so I added it at the end. You're going to take net income divided by preferred dividends, and then I've given you that information here. Okay, so what I want you to do again is pull up page 816 and try all of these formulas in the financial statements I've given you, and then you can check your answers in the video. And also, because there's so many formulas, not just from this chapter, but from chapter 19 and 20, also there's a lot of formulas. You'll be able to have a page of notes for your test, for your final exam. And so I'll make sure to tell your proctors that, but you can have a front and back one page of notes, and to include your formulas. I don't really care what's on your page, but you need to make sure that you have all your formulas on it because there's quite a few. Just the hard part is not remembering what the formula is, because that's easy to look up. It's, can you find the information to plug into the formula? That's what I really am testing you on. So good luck with your practice, and let me know if you have any questions.